Hey, how's it going? It's Bueno. So what I want to talk today about is the importance of figuring out where you can actually invest your money. So one of the biggest things that we deal with in our industry is when you're an entrepreneur or you're a business owner, you have a lot of different things going on. You kind of get to the point where once your business actually starts growing and you hit this growth stage, there comes a point where you actually have a lot of disposable income. You want to figure out how you can diversify your risk. And one way that we've actually found in terms of investing money is real estate has been one of the key metrics and one of really the key areas that a lot of people use to build up their personal wealth. So traditionally, a lot of real estate was, let's call it, segregated for the masses. You had to be part of a country club or, part of really like a special society sort of thing to get access to a lot of these different opportunities. But in the age, or in the digital age of today, we actually have a lot of different opportunities. In the past, a lot of real estate opportunities were actually, very limited, in terms of the people that got access to it. You had to be part of a certain club. You had to be, you had to know someone. We can even call it country club money. Whereas nowadays, in the age of the online marketplace, you have a lot of advancements in technology. In the capital market space, we've actually had companies, crowdfunding companies that you actually could invest in. And one of the biggest things is being able to understand how you're managing your risk throughout that entire process. And that really comes down to your due diligence on the platform, understanding the ultimate project, and lastly, really getting to know the operator who's behind everything. Now, to give you an idea, we're going to talk about a couple of the platforms. Some of the biggest ones, we have Realty Shares, we have Realty Mogul, CrowdStreet. There are a variety of different platforms you could choose from, but really the main thing is to be able to understand what your risk tolerance is and really how comfortable you are with, having your money locked up. So to give you an idea, if you're thinking, I want my money back in 12 to 24 months, the option that you typically have is you can invest in one of these like bridge products. Bridge is a special kind of loan. It's more shorter term. It's instead of like investing your money in a bank and you get, call it a 1% return, you could generally get a higher interest rate because of the short-term nature. That actually gives a lot of operators, such as myself, a lot of flexibility when doing certain projects. For example, we're looking at buying it's a $15 million project here in Los Angeles. We're in the process of negotiating it, and I'm noticing that a lot of people, they want to close this project and call it 45 days, 60 days, meaning from start to finish. Having access to a product like a bridge product actually allows me to pick up this project and call it 2 to 3 weeks. And given that sort of flexibility, those kinds of products are extremely valuable. They're extremely, useful really for the end user, but you really have to think about the fact that since you're only having, your money invested for 12 to 24 months, you're really limited and capped out on where the interest rate is. And there's also another alternative is if you're looking for, higher returns, you can actually invest in the equity. So call it, you get a percentage of ownership in that actual company. Now, it's a longer time period though. And we're talking 5 to 7 years, you're gonna end up owning an asset where you're acting in the capacity of what's called a limited partner, in which, you're almost like a silent partner. But in this case, that's where it becomes extremely important to understand who you're working with and what kind of experience they have in this field. Luckily, a lot of these platforms actually have gotten very good at screening these different individuals, understanding their risk profiles, and ultimately being able to put you together with the best projects that are out there. An interesting thing is when you're partnering up with one of these platforms, what you want to understand is who the ultimate person is that's running the project, what kind of experience do they have, and ultimately you want to get a certain level of comfort to understand that they can actually execute on these things. The benefit is when you go into a crowdfunding platform, a lot of that work and that due diligence is really done from the corporate level. So the platform itself, they have trained professionals who are screening every single opportunity, and they're questioning whether or not, you know, that equity or that debt investment with that ultimate operator, I guess on the other side, that's really me, whether that makes sense. And it's more for you to understand exactly where you're putting your money. Traditional real estate investments, on the other hand, too, they've been, call it more along the lines of you had to have all that money on day one and you had to come up with everything yourself. Whereas in the crowdfunding format, you can invest with literally as little as $5,000. What's really interesting about that is as you're going and you're really acquiring, you know, fractional ownership in a lot of these real estate portfolios, it gives you a lot of leverage because you can partner up with people who've been doing this for 10, 15, 20 years, and they've been through a lot of the different market cycles. So for example, when I started my business in 2006, we went through the financial crisis. We had a lot of experience with understanding how to manage risk, you know, pre and during the crisis. And that really changed a lot of really our perspective, so that when in 2014, when I met Ty, we were having a couple conversations about how to expand a business. You know, we got into the 67 Steps program. And as we're learning really, you know, the true skills of what it takes to really build a business up, me becoming that subject matter expert in this field of real estate really opened up my eyes in terms of, you know, how to manage risk and how to effectively be able to get this project from start to finish. So how does this work? If you're investing in the equity, you're actually owning a percentage of that limited liability company. And what makes that great is that you actually share on a percentage of the profits in terms of the cash flow from day to day. And when there's ultimately the sale, you actually get a percentage of that as well. When you're going to invest into an equity project, you're looking at not only understanding the operator, but you also want to get an understanding of what market conditions are they forecasting? How are they thinking about how they're getting the project from start to finish? And being able to really understand and dig down into those details will really make you, on one hand, more knowledgeable about the process, but on the other hand, it'll also give you a lot more comfort of how these projects typically work. And I think it's really important to understand the risk tolerance that you're really taking on in terms of, you know, these kinds of projects. If your day-to-day job is, for example, you're running a social media company, that's really where you should be really focused on. And being able to invest outside of that, it's very, very critical to surround yourself with great people. As Ty always talks about, you want to be surrounded with great mentors. And really when it comes down to your peers, you want your peers to be the best in class in that specific segment that you're operating in. For me, I actually operate specifically in the multifamily segment. I focus on apartments. We've been doing transactions really across the United States for the last, I want to say last decade. And as we really think about, you know, how the market has changed, you know, how it's evolved between the ups and downs of the Federal Reserve and, you know, interest rates really being at all-time lows, it's giving us a lot of flexibility, not only in terms of acquiring good opportunities, but we're looking for the diamond in the rough, call it the mismanaged property that doesn't have the best person managing it, or we're looking for the property that it could have been built a little bit bigger, but someone left money on the table, or the regulations changed. And we come in and we really capitalize on that. Now, every business plan is different. And as you think and assess of your risk tolerance, you can think about it really from 4 different scenarios. The first one is your core investment. Core investments are, call it very nice apartment, a very nice house, or whatever the real estate investment is, you know, in a very nice neighborhood. Call it Beverly Hills, Santa Monica, you know, one of these, you know, higher density, or I guess call it just better neighborhoods. But your return is actually going to be a lot lower because in the world of real estate, you're compensated for your risk. So because there's not much risk in really owning real estate in Beverly Hills, your return that you typically get for a project like this, call it, it's anywhere from 2 to 2.5% per year. As opposed to a core plus investment. This could be in a given location, call it, in a different neighborhood. Maybe it's a up and coming neighborhood like a Mid-Wilshire or a Koreatown. I know we're talking specifically here to Los Angeles, but I want to give you an idea of what that kind of profile looks like in terms of the different opportunities. Your core plus investments, they'll get you a little bit of a better return, anywhere from 5 to 8% per year. That's typically where you're going to find things, and that's really annualized over the course of that investment. And then you have more of the value-added projects. So these are projects, and it could be a project that needs a little bit of work. Someone hasn't been doing what they're supposed to be doing. Maybe the rents are low. Maybe the expenses are too high. Maybe they're targeting the wrong demographic. So the wrong person is living in these buildings versus if you pivoted the business plan a little bit, you'd be able to get a better clientele in there. These kinds of projects are really located in any one of these neighborhoods, but it really comes down to how you're looking at, assessing the opportunity. So when it comes to these value-added projects, for example, you're looking for someone that has, the ability not only to carry out that business plan, but that has, really good data to be able to support the facts. So for example, we picked up an apartment portfolio in the Midwest. Some of the properties were actually closer to hospitals, and one of the properties was actually in between a hospital and a university, and the kind of population that was actually living in this community, they were actually more of, call it, more in the lower income segment. And when we picked up this building, we quickly realized that the best thing that we could possibly do, not only for the community, but for really the investment itself, was to find the perfect demographic to be able to partner with and actually to be able to help create housing opportunities. Now for us, as full-scale developers, we're really looking at how can we get a project really from start to finish and partner up with local subject matter experts. So in this case, we partnered up with the U.S. Office of Refugee Resettlement. We found that there was a huge need for this demographic, even though on first glance, maybe catering to the nurses or to the students seemed to make a lot more sense. But as we noticed, we thought about the opportunity from a holistic perspective, and to be able to bring in a lot of political refugees, we really felt we were doing a lot of good for this community. Secondly, over time, we also realized that, with the new administration coming in, we wanted to be able to target the people that ultimately would be able to get us, to the numbers that we were trying to get to. And to be able to execute that business plan, we ended up working with the Veterans Association. With the veterans, we're able to house a lot. I think about 25 veterans we helped house last year in between Thanksgiving and Christmas time. And this is just to give you an idea of how methodical you need to think about each one of these opportunities when you're investing in a crowdfunding platform. So ultimately, value-added projects, they need to have some sort of comparable. You want to be able to look and say, this is what my project's going to look like, and this is what it's going to feel like, and this is who it's going to cater to when I'm done with this. There's a lot more risk in that. Maybe the business plan works, maybe it doesn't. So because of that, you need to be compensated for that risk. So you want to think about anywhere from 9 to 12 to 13% for that sort of project. And then ultimately, the last one, so we talked about core, we've talked about core plus, we have the value-added projects, and ultimately we have opportunistic projects. Now, opportunistic projects, probably not where you want to be at on your first project. These will get you a higher return because you're taking a lot more risk. So this is getting an apartment complex and completely demolishing it to rebuild into something else. The kind of operator that's doing this needs to have a lot of experience. You they better have been doing this for at least 7 to 10 years, because you want to know that the person you're partnering with not only understands this inside and out, but has the experience to really be able to carry out this business plan no matter how the weather blows and how the economy really goes. So ultimately, why invest in a project like crowdfunding versus a REIT? A REIT, if you're not familiar, is a real estate investment trust. It's actually a publicly traded company. And what they end up doing is they raise money using the stock market to be able to buy apartment complexes, or to buy hotels, or to buy manufacturing facilities, or really whatever their investment thesis is. The reason why investing in crowdfunding is actually a lot more appealing than investing in a REIT is because you actually have more control, since you're working on one project at a time, versus a REIT, it's the conglomerate of the 50, 100 different projects that they have going at any given point in time. For us, managing risk is imperative. It's actually one of the most important things that we want to think about in the world of finance. So with real estate, for example, we want to know that we're partnering up with the right people. We want to know that our projects, we're mitigating the risk. We want to have an idea of what that timeline is going to look like. And in terms of how a REIT is typically structured, because you have the ability to buy in and buy out, your returns are actually a lot lower compared to investing on a project by project basis. Now, another opportunity that we have is actually investing your money in, let's say, a bank. Now, if you're on the debt side, for example, right, and you're investing in a project that you're expecting to get your money back anywhere from 12 to 24 months, these projects, if you were to invest directly with a bank, maybe you get 1% for your money. You have it in what's called a certificate of deposit. Versus if you do it on a crowdfunding platform, not only do you get a higher return, but because it's so tech-driven, you actually get a better return, because the platforms are run a lot leaner. So if you're investing in a bank, you have the accountants and the tellers and the bankers and everyone that needs to get paid everywhere in between. That's why you're only generating a 1, maybe 2% return if you're lucky. Versus if you're investing in a crowdfunding platform, returns typically could be anywhere from 5 to 8%, depending on what platform you use and how the fees are calculated and all that. I think the most important thing, as Ty always talks about, it's you want to be surrounded by people who not only, one, understand this, but two, you want to be able to consume enough content to get a general understanding of how this field works, and you really learn that in the due diligence process. So, to recap, crowdfunding, it's an amazing way that you can actually invest your money. You get to leverage people that have been doing this and focused on this 100% full time for the last decade, for example. And you're able to get in, benefit off the last decade of all the lessons that they learned along the way. And at the same time, you get the opportunity to not have to have tenants calling you in the middle of the night when their toilets are leaking. You get the benefit of generating cash flow. And really from a tax perspective, you actually get, some of the depreciation along the way. You get to actually offset some of your income, if certain things happen in the business. And I feel that crowdfunding really gives a lot of opportunities for different entrepreneurs to be able to make money as a second income. So we have a variety of different ways that we can actually get smart about this. I blog a lot. So for me, it's like I write a lot on LinkedIn. I publish a lot on Medium. Those different websites actually give me a lot of access in terms of being able to communicate with my audience. And ultimately, the biggest thing is you want to educate yourself. There are a lot of great books out there. There's a lot of great courses. Most importantly, being able to really understand how the real estate process works really comes down to getting access to this sort of information in the world of the internet. You can get it really anywhere. You have a lot of great forums out there. Biggerpockets.com is a great forum that my friend Josh runs. Ultimately, the more you know, the more you grow.